Jim Chanos, a famous hedge fund manager and a short seller with $1.5 billion net worth, has shorted Coinbase since Q4 2022 and still believes it's a low-quality narrative stock. On the exact 180-degree opposite of this short position sits Cathie Wood, CIO of ARK Invest, who has allocated almost 5.6% of her flagship ARKK ETF to Coinbase. Are you Team Jim or Team Cathie? Who's right here? As Jim Chanos believes, is Coinbase destined for failure or to become the next big winner as Cathie Wood claims? Let's find out. My name is Horamer, founder and CEO of StockCard, and I am fascinated by two extremely opposite points of views about Coinbase stock from two experienced investors I respect greatly. On the one side, we have Jim Chanos, whose portfolio has been up by 256% since June 2013, beating average hedge funds by a significant margin. On the other hand, we have Cathie Wood's detailed and in-depth research and analysis into future of innovation and cryptocurrency stocks. It's hard to listen to both sides, not to go insane. How can two people look at the same company and the same information and have two completely opposite conclusions? My plan in today's video is not to go insane first and then dig into the company's fundamentals and discuss both sides of the story. After all, the sign of intelligence is to have two completely opposite ideas in the mind and not go insane. I'll research Coinbase's fundamentals by evaluating its business model, revenue growth potential, profitability, and balance sheet, and wrap up the analysis with an overview of the stock's current valuations. In each section, I'll tell you whether I agree with Jim Chanos or Cathie Wood, and in the end, I'll tally up their scores and share my plan on whether I'll buy Coinbase shares or not. As usual, I'll use the StockCard platform to research the stock's fundamentals, and I'll suggest you pull up Coinbase as a StockCard on your own and do research along. Creating an account on the StockCard is free. The link is in the show notes. Before starting the research, let me remind you that I'm not a financial advisor and this video is for education only. You should do your own research and remember that investing has risk. You can do all the research in the world and still lose all of your money. That's the nature of this activity we call investing. And now, which team do you think you belong to? Team Jim Chanos or Team Cathie Wood? Let's find out. As we all know, Coinbase is a regulated, centralized cryptocurrency exchange in the United States. It makes money by charging its customers a transaction fee who use the platform to buy and sell cryptocurrency assets. It also makes money from spreads, typically a few cents difference between what you and I buy an asset versus sell it. The third way it makes money is through a recurring subscription fee in exchange for free transactions. Right off the bat, the red alerts go off. Coinbase's primary revenue is from transaction fees, which should be headed downward if the stock market is any guide here. Robinhood disrupted traditional brokerage businesses by eliminating transaction fees. It could be fair to assume that the next generation of cryptocurrency exchanges could eliminate the fees and eat Coinbase's cake, so to speak. This business model red flag is the primary concern of many investors about Coinbase's long-term financial success. It could keep charging people transaction fees in the next few years, but in the next 5 to 10 years, it may not be as sustainable of a business model as it is today. Actually, it's not a sustainable business model even today. It's heavily reliant on trade volume and cryptocurrency prices. For example, in 2021, the company's revenue was more than $7 billion. That figure dropped to slightly above $3 billion in 2022 when cryptocurrency trade volume dropped by 69% and price crashed from all-time highs. Also, remember that the subscription revenue is still too small, hovering around $110 million for the last fiscal year. We don't have enough data to believe the subscription revenue would make any difference in the company future, especially compared to Coinbase's more than $5 billion in operating expenses. So in the battle of Coinbase, Team Chanos gets the first point thanks to Coinbase's business model risk. If the current revenue isn't sustainable for long, why is Cathie Wood buying shares whenever she can? In 2021, Cathie argued that most of Coinbase's growth potential would come from institutional investors' interest in cryptocurrency assets, especially Bitcoin. In November 2022, Coinbase published a survey of 140 institutional investors in which 58% confessed they plan to increase their cryptocurrency asset allocation in the next 3 years. Moreover, in the latest earnings call, Coinbase's CEO, Brian Armstrong, discussed how the company onboarded several new hedge funds to the platform in Q4. That's intriguing considering that crypto assets like Bitcoin were at their lowest levels since 2020. Because Coinbase is a publicly traded, audited, and most regulated exchange to trade crypto assets in the US, it's fair to assume that it will be the primary platform for institutional investors to purchase and manage their cryptocurrency allocations. There is market data to confirm this assumption. The global asset under management invested in digital assets is up from $10 billion at the end of 2018 to $55 billion in Q3 2022 after the spectacular drop from the all-time high of $70 billion in 2021. So in a matter of a decade or so, the asset under management in digital assets by crypto funds, a good proxy for institutional investors, grew by more than 5 times. Moreover, specifically for Coinbase, the partnership with BlackRock to allow BlackRock's institutional investors to use Coinbase to invest and trade cryptocurrency assets is another sign that the company can benefit from institutional investors' allocation to digital assets. I spent quite a lot of time trying to forecast the potential revenue for Coinbase as a percentage of asset under management that is expected to be invested in digital assets. However, I didn't find reliable assumptions I felt comfortable sharing. So there is potential growth for Coinbase as more institutions invest in cryptocurrencies, but it's hard to quantify it. Cathie Wood is not too wrong about Coinbase's future, but the future is very uncertain. Team Cathie wins half a point here. Let's talk about profitability. If you watch some of the videos around 100 bagger stocks on our YouTube channel, and I'll link the series in the show notes in case you want to check them out later, you'll know growing earnings potential and the ability to generate free cash flow is fundamental to having the next big winner in your portfolio. Jim Chanos drives the point across by focusing on Coinbase's lack of profitability and the race toward running out of cash. If you dig into the company's P&L, you can't do anything but agree with Jim. In 2022, Coinbase burned through $5.3 billion to run its operations, net of the losses it incurred from the price drop in cryptocurrencies it holds. As is customary by tech companies, Coinbase reports and adjusts earnings figure, adding back stock compensation and other expenses that aren't cashed out of the company's pocket in that quarter. Even after those adjustments, the company lost $371 million for fiscal year 2022. Jim summarizes the whole story in one line. On top of not having a sustainable revenue model, Coinbase is still losing money, and he can win a point against Team Cathie for that. But in defense of Team Cathie, we should talk about Coinbase's $5.7 billion cash balance on its balance sheet, excluding customer assets. Compare that cash balance with $3 billion in long-term debt due to in a few years from now, and you'll see Coinbase has solid cash position. Yes, Coinbase is burning through a lot of money, but it also holds a lot of cash on its balance sheet. Therefore, the risk of running out of money is lower than in Jim Chanos' picture, giving Team Cathie at least half a point here. One last piece of fundamental information we've got to review together is Coinbase's valuation. Coinbase as a stock is priced at roughly 4 times its sales when the video is shot. This means investors already believe Coinbase can grow its revenue by 4 times. Assuming the company can grow as fast as the overall cryptocurrency exchange market at 14% per year, in 10 years, Coinbase can grow into its current valuations. The question is whether Coinbase can grow faster than the market's 14% annual growth rate. If you believe so, then the stock can be undervalued now. If you don't believe Coinbase can grow faster than 14% per year, then the stock is overvalued at this point. From what I've learned researching the market, there are at least 4 factors impacting Coinbase's growth. Firstly, we discussed institutional investors' expectation to allocate more money to digital assets. Similarly, the market expects more retail investors to get familiar with digital currencies, which can bring more growth to Coinbase. Thirdly, the lack of a regulatory framework is a big risk to the market, and from the recent activities, we know the US regulators are quite adamant about regulating the industry. In the short term, that could mean a lot of banning and limitations, but any regulatory framework can lead to long-term stability and growth. And fourth, for Coinbase specifically, international expansion can also be a source of growth as the company currently makes most of its money in the US. Combining those factors can result in a faster growth rate than 14% per year. At the same time, I can still argue against it and come up with scenarios where the growth rate is lower than 14%. For example, Coinbase revenue forecast outlook for Q1 2023 is about 6% quarter over quarter for the subscription and other revenue segment, and the company hasn't provided any forecast for the transaction fee revenue at this point. In other words, the growth rate is likely lower than 14% in the short term based on the company's outlook. At this point, there is too much uncertainty to make a confident conclusion about Coinbase's valuation. Neither Jim nor Cathie's team win any point here. So let's summarize what we've learned about Coinbase today. Coinbase revenue relies heavily on charging customers a transaction fee, which is an unsustainable business model on the long run. Secondly, institutional investors are expected to allocate more capital to digital assets, and Coinbase already has the infrastructure and partnerships to serve them. Third, the company burns a lot of cash each year, but has enough cash to support its operations for a few more years without worrying about any immediate debt. And fourth, it's very difficult to value the stock and figure out whether it's overvalued or undervalued, as there is argument to support both sides. At this point, more points favor Jim Chanos' argument, and we can conclude that Coinbase isn't a fundamentally solid company yet. However, I do see Cathie's point of views too. Investing in Coinbase now is quite similar to investing in a startup company. It has a lot of risk, but if all the stars are aligned, Coinbase has the head start, credibility, and cash to lead the market. For those reasons, personally, I don't feel the risk is justified to own shares of Coinbase in my portfolio. Still, I own shares of ARKK ETF, which owns Coinbase in its top 25 holdings, and that should cover me in case I'm too conservative in my fundamental analysis today. Let me know what is your strategy when it comes to Coinbase and whether you have a different take on it. Share your research in the comments. And don't forget to pull up Coinbase's stock card to complete your research. The link to Coinbase's stock card and few other good resources and videos to watch next are in the show notes. I'll see you next time.